Hello everyone and welcome to the Token City Show. Today we have with us Mike Manning. Mike is a strategic advisor and former fintech executive focused on the business applications of digital assets, cryptocurrencies and CBDCs. As Amazon's first head of blockchain and digital currency, he led the company's strategic engagement with central banks and helped shape the design of the digital euro. He has held senior roles at Figure Technologies and Symbiont, advancing blockchain use in capital markets, and he was also the founding CEO of Deal Vector, a fintech platform improving transparency and liquidity in structured finance. Hello, Mike, and welcome to the show.
Hello, and thanks for having me.
Thank you for coming on. So why don't you start by telling us how you first got involved in the blockchain space and what motivated you to do so, and how are you now active in it?
Sure. So I got into it kind of by accident. About a dozen years ago or more, I founded Deal Vector, the fintech you mentioned. Not knowing anything about structured finance or fintech, I started a structured finance fintech, which wasn't quite as crazy as it sounds because my co-founder did know the market quite well. What we were trying to do was to pierce the information veil that exists around asset ownership. Because of central securities depositories and the indirect nominee system, there's no registry anywhere on earth of who owns what, which can create problems in the financial market. This is actually a problem that blockchain solves more elegantly with the central shared ledger. A lot of the work we were doing at Deal Vector was around asset-backed securities and RMBS. That led me to two blockchains that are focused in this area. Provenance, which is a blockchain used by Figure Technologies or Figure Lending to originate U.S. residential loans on chain. They'll do about $12 billion this year, I think. And then also Symbiont, which was also capital markets focused blockchain, where I worked on ABS bond issuance, FX and FX collateral mobility issues. I then moved, as you said, from the kind of blockchain side or the finance side over to a corporate. And as Amazon's head of blockchain digital currency, I explored use cases in payments and treasury, and also led the development of our digital euro prototype with the European Central Bank. So I've seen the market from a number of different perspectives, but always with a focus on real world assets or using blockchain to drive efficiencies in traditional financial assets or services that we would recognize.
I wanted to ask you specifically about the current time, the specific moment in time that we're seeing currently in the space. There's a lot of things that are happening, and I would like to have your input into how you see the moment for traditional finance bridging the gap with decentralized finance, and in your opinion, why has that taken so long to start to take shape?
Yeah, we are at a very exciting moment in blockchain and the bridge over to traditional finance. Stablecoins have exceeded 200 billion in issuance and represent just under 10% of the entire cryptocurrency market valuation, which is remarkable for an industry that started with the idea of non-fiat currencies. Treasuries are at about 5 billion right now, and Figure, as I mentioned, has issued around 12 or 13 billion in HELOCs. So that's very significant, and it's very significant growth, and the growth curve is very rapid. But in the context of the broader financial services industry, the broader financial assets industry, that's still relatively insignificant. RWA.xyz estimates there are about $20 billion in RWA issued on chain, excluding stablecoins. I've read studies from McKinsey and others that suggest it's 30 to 40 billion. But whatever the number, it's just a drop in the bucket of the $115 trillion in equities or $140 trillion in fixed income, not to mention real estate and other large asset categories. So yes, it's tremendously high potential, and you get very exciting estimates of what's going to happen in real world asset issuance simply by taking those very, very large numbers for the asset category and multiplying them by fairly reasonable rates of penetration. And I think that's going to happen, but I think the time frame is uncertain, and it's not quite as inevitable as some of us might like to think or might hope. The first digital bond was issued by the World Bank back in 2018, and there is still really no real demand for DLT bonds that are out there. There've been lots of failed trade finance projects, many of them backed by major banks, And then I've kind of lost track of the number of supply chain initiatives that have been announced but haven't really taken off. So what's taken so long? Well, I think a big part of it is that we've been missing key building blocks to allow a complex financial ecosystem to develop around these assets. It's not just the asset, it's a lot of things that go around it. In particular, having a reliable settlement mechanism is important. And I think stablecoins, that's why stablecoins are so excited, is they've really unlocked that. We've also now got, I think, more mature wallet technologies, things that will handle institutional grade use cases where you need to have separation of concerns and multi-sig and other things that will operate within the workflows of traditional institutions. So I think that's a big part of why it's taken so long. We're just getting to that point where we've got the critical mass and of input building blocks in order to begin to really accelerate the adoption. However, another part of it is that I don't think we've been as disciplined about identifying the use cases that are going to be most compelling for the industry, or identify those things where blockchain performs in a clearly superior way to traditional rails. McKinsey ran a roundtable on tokenization back in May of last year, and their first finding, based on the interviews they did leading up to the roundtable with industry experts, was that there was a clear need for a refined business case for tokenization by asset class. And then they went on to say that there's, surprisingly, not a coherent story around the business case for tokenization, and I'm quoting here, that clearly calls out the underlying pain points addressed by the technology. So why would they say that? Because there are a lot of obvious benefits to blockchain technology in finance, but I think it's important to figure out which of those are unique to blockchain or the blockchain does particularly well. And I don't know that we've always chased the most important benefits. I'll give you two examples of that. One is fractionalization. This is the benefit you often hear touted around blockchain, that you can now fractionalize assets. And it is a benefit, but we've had shares for hundreds of years, ever since the Dutch East India Company invented that back in 1602. So fractionalization is clearly a powerful financial tool, but it's not particularly new or different or unique to blockchain. Now, I know it allows you to fractionalize things that you wouldn't fractionalize today, but I think that it's still more of a nice to have as opposed to a must have. Or maybe a must have, but it's necessary, but not necessarily sufficient to drive demand for an asset. You've got to want to buy the asset first before you need to fractionalize it. The second thing I'd point to is liquidity. So there's kind of a widespread belief that it's not unfounded, that if you can, tokenization will allow you to sell your asset to anyone, anywhere on Earth, and that should bring more liquidity into the market and therefore make the overall market more efficient. And while that's true in theory, just because somebody can buy your asset doesn't mean they're going to want to buy your asset. And the reality is that for most large asset classes, the liquidity is so great in the traditional finance markets that blockchain is actually operating at a disadvantage there. You lose liquidity when you move things on chain. And I'll just give a quick example from my own background. When I was at Symbiont, I was working with a top 5 asset manager and a major manufacturer to issue an ABS bond. And this one particular portfolio manager I've been working with had been touting the benefits of tokenization, digitization for longer than I'd even been at the company. I've been hearing at conferences. And as we got close to the issuance point, I asked him, so how much of this are you going to buy? And so I can't buy any of it. I've got a fiduciary responsibility to my clients. And I said, well, what do you mean? What about all these benefits we've been talking about for years and years? And he said, well, the fact is I need to be concerned when I get into an asset, how I get back out. And I'm going to have more secondary liquidity on this same bond. We're going to issue it both on-chain and off, fractions of it, in a traditional mechanism than I will in the on-chain. And so I can't actually buy it because it's better for my clients to have the traditionally issued bond. So I think those are two examples of where you've got benefits that are real or potentially real, but we really needed to do a better job about mapping the benefits to the particular pain points that the market values, because I don't think those have been sufficient to get people to issue on-chain.
Yeah, I see your point. At the same time, I feel I have to offer a counterpoint. Very, very simply, it's true. I see that what you're saying is basically, you need to have, as long as you don't have critical mass, the technology doesn't really matter. As long as the technology, the current technology or traditional technology already works, there's critical mass there in terms of liquidity, so to speak, right? Yeah. At the same time, though, if this was all there is, we wouldn't see, for example, in Switzerland, the stock exchange in I don't know how to say this term in English. Bern, I think Berna. I know it's in Spanish. It's a Swiss city. I'm not sure that it's pronounced like that in English. Its traditional setup has an annual volume of 1.5 trillion. But they just got FINMA license. It's the regulatory supervisor there for their blockchain deployment on Polygon. They are owned by the Stuttgart Stock Exchange from Germany. So these are large organizations in Europe that are pushing for the use of blockchain, even though there's the roadblock that you mentioned, which we also, on the other side of the pond, we have, Larry Fink, who, as you know, has been, singing the praises of blockchain and trying to direct the discourse towards blockchain implementations for years. So there must be incentives from these institutions, even if they are marginal, but maybe the point here is that at large scale, those marginal incentives are probably the reason why blockchain does matter to them. I would posit. Would you like to respond?
My argument is not that it doesn't matter. It's that we have to find the benefits that matter the most to get people over the hurdle. Because I think the key words that you said in that was 4 years. I think has been pushing this. And we've been going at this for years and trying to get adoption, and it really has not taken off by and large. The Treasury, $5 billion in treasuries that I mentioned is a really tiny fraction of the overall treasuries market. And so the question is, what's going to actually get people over that pain point to adopt? Because one of the things that I found very challenging is when I was at Symbiont, for example, we talk about the ability to eliminate counterparties. You don't necessarily need custodians. You don't need a transfer agent. Transfer agents are the one everybody talks about. And you can get to a very large number of savings by taking a very small number, like three basis points for a TA, and multiplying it by a very large asset class and saying, yeah, at scale, it's worth an incredible amount of money. Let's go do this. But the problem is that it's still only 3 bips for any given deal. And so things can be very valuable in the aggregate across all deals, but there's a significant opportunity cost to getting there, and each individual deal is going to be priced and put together by a particular institution. And if it's only 3 basis points, it's very hard to get traction in that. So this is not to say it's never going to happen. It's just to say we've got to be mindful of the timing and figure out what we're going after first. You mentioned equities in the Swiss market. In the McKinsey study, they had a really interesting framework for determining when they thought digitized assets were going to launch by asset category, and they had 2 axes, because it's a consulting firm, so they've always got a 2-axis box. One was the feasibility of launching on chain, and one was the desirability. And the ones that were farthest out in terms of likelihood of deploying were things like equities, where you're dealing in highly liquid markets, and you've already got a very well functioning system. I think you're more likely to get adoption, around the edges in asset categories that are number one, not as well served by traditional capital markets. There are a number of them. And then also 2, where you can do more than just put a token on a chain. You've got to be able to digitize, I think, more of the life cycle, the complete asset life cycle. And that's where you're going to start to see more benefits. And you're going to find things that blockchain can do just flat out better than traditional rails, and not by a basis point or 2, but maybe certain things that couldn't even happen.
Okay, so let's stay with the alternative assets angle, if you don't mind, because yes, that is true. There are categories of assets that find less liquidity in the traditional sector, and therefore they are more likely to gravitate towards the blockchain space. And well, there's somewhat of a funny or ironic situation here where traditionally less liquid assets like alternative assets, because they have the potential to gravitate to blockchain more easily, suddenly they are in a position in which alternative assets, primary issuance, secondary trading is positioned to see a technological upgrade and suddenly see things like instant settlement, right? Which are still a long way off in the traditional sector. So, does this mean anything for the private capital industry in general, in your opinion?
Well, clearly, private capital is one of those things that is often talked about with respect to blockchain, and it absolutely meets that criteria that you mentioned, which is don't tackle a market that's highly liquid today. Don't compete against something that's functioning very, very well. But I think we need to talk a little bit more about the specific type of asset we're talking about with alternatives. There's been a number of attempts to tokenize private credit in individual companies, and I think that hasn't really gotten a lot of traction. Partly for the same reason I just mentioned, which is that liquidity, which was what we're trying to solve here, is much more a function of the number of buyers and sellers in the market, not a function of the underlying technology. So you can make it easier to transact, but you still need the desire to transact. And so now we're seeing, I think, a lot more funds, alternative asset funds that people are talking about issuing. And that's kind of moving up the financial stack, and it's probably an easier asset for a wider number of people to buy rather than evaluating individual companies, let's say. What I hear about from people who are launching funds on chain is much more about gaining access to new customers and secondary trading rather than the instant settlement benefit. And the secondary trading to me inherently makes sense. There's typically an illiquidity premium to these alternative assets, which means investors demand a higher return. And if you could get and there's also a lot of friction, by the way, in transferring these assets. So depending on the asset, in some funds, you actually need manager approval to sell in the secondary market. So all of that friction makes it really, really hard for a secondary market to develop. And if you could digitize that process, you could have an asset, a digitally issued form of that asset that is able to transfer peer-to-peer directly, and also carry with it all of the operational checks or all of the compliance checks or all of the manager requirement checks to either allow or disallow that. You really set the stage, I think, for allowing a secondary market to develop that could be very powerful. Also, digitizing the onboarding process with the KYC could make it more accessible as well. But I look at both of those conditions as, again, necessary but not sufficient. You're still going to have to go out and you're going to have to generate the demand to buy and sell these assets. And especially as you get into alternatives, they become more unusual assets, right? It's not like a share of IBM stock where a share is a share is a share is a share. Alternative assets require often a little bit more sophistication and a little more difficulty in underwriting. And so that's going to begin to narrow your buyer base to some extent. So I think private capital absolutely has a huge opportunity with blockchain by removing a lot of these structural impediments to bringing people on or allowing secondary trading, but it's really just one half of the puzzle.
Good. Okay, so now staying a little bit on the other side of the street, so to speak, there's clearly, like you were hinting at, the potential for improvements in private debt specifically. So what you have a very long experience in this aspect. What would you like to see if you could just draw a picture of what you would like to the next developments to take place? What would you in that case say that would be best?
By the way, pointing out these issues is in no way to detract from, I think, the incredible excitement that exists around financial assets and this industry. So the financial business is fundamentally a business about maintaining ledgers. And what blockchain has given us is this phenomenal new ability to have a shared ledger that all of us can see. And there's no question that's going to revolutionize the industry. I think the key benefits that come from that are you're going to be able to reduce reconciliation expense, we'll be able to see greater automation, we'll be able to accelerate settlement, and we'll reduce counterparty risk. And so I think what we want to do when we're looking for those asset classes where we're going to get adoption first is we need to focus on those areas or those particular asset classes or use cases where those four things are most pronounced: reconciliation, ability to automate, accelerate settlement, reduce counterparty risk. And I think that blockchains, when looking at that, I think of blockchains as doing three things particularly well. It provides a universal registry, as I mentioned, so that we can all see a given asset and have agreement as to the current ownership state. Because of that, it allows much more seamless transfers or state changes of that asset. And then finally, it allows for the automation of lifecycle events. Things like, for example, receiving an interest payment on a bond and amortizing the principal. And so assets can benefit by incorporating any one of those three or all of the three, but I think where you benefit the most, to answer your question, is where you're able to do it all, and particularly automate certain lifecycle events on chain. So let's talk about two examples to kind of illustrate that a little bit. What we see right now getting a lot of traction, a lot of attention in the market, of course, are tokenized treasury funds. And tokenized treasuries in and of themselves as an investment vehicle, I don't think are particularly interesting or exciting. They have the same underlying collateral as a traditional treasury. They generate the same yield. If anything, they've probably got a slightly higher cost load because you typically end up replicating their share classes of existing funds, and you typically end up with a somewhat redundant TA costs or record keeping costs. They do have utility for firms, let's say in the crypto industry, who want to store their cash in something other than a bank account. So they can move their treasury or their cash holdings into a treasury, earn a reliable yield, and back out again without having to go in and out of bank accounts. And there's some error, but that's almost by definition a fairly small portion of the overall crypto market. However, tokenized treasuries are incredibly, and that's when you begin to move to these second order benefits, and you take advantage of the transferability that I just mentioned, the ability to move assets back and forth. One of the project I worked on at Symbiont was something called Smart Collateral, and that was able to cut using blockchain-based calculation of variation margin. It was able to cut counterparty risk by 85%. So what does that mean? Well, if you and I have a Euro USD trade that settles in 30 days at the current exchange rate, as time goes on, the price is going to move up and down relative to the strike price we set. And that means that one of us is in the money or out of the money. And these are very, very large dollar amounts at stake in FX trades. And so in order to prevent the out of the money party from walking away and washing their hands of the deal, the market has the out of the money party post variation margin, or the amount that they're out of money, to an escrow account every day. And today that happens once a day typically, and it can take some time to move the collateral that you're posting into the escrow account. Well, that means you can be out up to 48 hours, more commonly 24, but up to 48 hours to your counterparty with a significant price movement. What we found by creating an application that took an oracle of pricing feeds, calculated mark to market every 15 minutes, and then would post collateral, that we could cut counterparty risk by 85% because there's a much smaller time increment over which prices could move. Well, that was great, but we still had to execute those transfers through traditional mechanisms. With tokenized treasuries, however, now you can begin to automate both the mark to market and the posting of that asset back and forth. And so now we've got a system that can dramatically cut counterparty risk, like I said, by 85%. And that begins to open up all sorts of new possibilities. Now I may be able to do more of my FX trades on a bilateral basis rather than having to go through a CCP. Or I think more significantly, I may be able to face a wider number of counterparties that I might not face if I had to be out to them for a day. Or you can lower the capital charge involved in running an FX desk, which would lower the overall cost and improve the conversion rates. So that's an example of how tokenization, or the representation on the ledger, is kind of step one. But when you begin to get into more life cycle events, the value magnifies significantly.
Yeah. This use case that you have just mentioned, I'm just wondering here out loud a little bit while I'm online with you. So do you think we will see this taking off? What's your view on that? Because it does seem, going to the beginning of the interview where you were actually saying, you know, we should probably focus more on the use cases that really work. Do you think there's potential to see this, you know, more broadly in the Forex space?
Absolutely. And you know, I think you actually sent me right before the interview the article on the repo platform that Broadridge is using. That's a slightly different application, but they're claiming to be doing about $1 trillion a month in repo trades, back and forth on a DLT platform. So absolutely, I think that's the kind of thing that can really get us up to scale. Another example that I'll give you, actually, which the tokenized treasury example and the collateral mobility really deals with those first two benefits that I mentioned: the ability to use the on-chain registry and the ability to transfer state. But it doesn't really get to that third one yet, which is life cycle events, which is, you know, the thing we were talking about just now is more like trading, mark to market, our kind of life cycle events in a derivatives trade. But the other example, where I think is the most complete example of where this end state looks like, is the work that Provenance and Figure are doing. So what Provenance set out to do, or Figure set out to do, and they're using the Provenance blockchain to do it, is to issue digitally native assets on chain. And so what they're doing is they're issuing mortgages, or actually HELOCs, home equity lines of credit, which is a type of mortgage, effectively, to real world consumers. All of the information about that loan, the loan document, the promissory note, the credit score of the consumer, is all committed to chain in a verifiable way. So a third party can look at the FICO score, for example, the credit score from Fair Isaacs, and be confident that it was real. They can look at the appraisal of the house digitally signed by the appraiser, know that that's real. That means that they can then diligence that loan automatically via smart contract, rather than what happens today, which is you literally have people looking at the loan documents and the loan tape and comparing $70,000 loan, yep, $70,000 loan, 5%, 5%. That costs about $300 to $400 per loan in the traditional world, and each loan gets diligenced multiple times. Well, that cost goes to virtually zero, which means you can actually now pledge loans loan by loan into a warehouse as an issuer, pull that back out, bundle it into securities, and those value points aggregate all the way up the value chain to the point where Figure claims that they take 100 to 125 basis points out of the total cost structure of the end-to-end process from loan origination to securitization. And they have gotten to the point where they're going to issue about 20% of all US HELOCs on chain this year, the entire asset class. So to answer your question, here's the first example I think we hear. I think it's one of the greatest unsung success stories in the market. Here's the first example that we see of not only volume, but volume at scale relative to the asset class. This is arguably the first asset class to truly be disrupted by blockchain and digitization, because they've really tuned in all the variables right, and they've demonstrated immediate cost savings, immediate capital acceleration from implementing this on chain, and that's allowed them to get up to this point of actual disruption for the industry. I think you're going to begin to see more and more of that. The FX example is a good one. That's still the repo example I use is a very good one. That's still a very, very, very tiny amount of the overall market, but once it's proved out, I think it's got the potential to grow fairly rapidly.
Absolutely. The example you just mentioned with Figure accounts for you know, a large portion of the fact that private credit is you know, stands out in the world of real world assets tokenized today. That and some other examples, but yep. They start. It's 20% is just an awesome figure to learn about. So, last.
And by the way, I point out the reason for that. We often refer to tokenization of the assets. I think that a figure really is called digitally native issuance, which I think is a little different. I think it's really important not just to represent the share class on chain, but to the extent you can execute the underlying life cycle events of that asset on chain as well, is where you really get to the value. Just having a number in a database that you can push around, you know, has value, but it's really when you're thinking very, very thoughtfully about how do we use this to take operational costs out of the system. And in many cases, what's really happening is it's not so much tokenization, but it's digitization that is driving this value. So automating the process so that things can happen smoothly on a straight through basis. Consumers see the loan document on chain or online and can sign it. And that is not block tokenization per se, but what I think tokenization does is it can take the output of those workflows that get digitized and then record them in a way that embeds them in the asset such that you can begin to trade them and execute other various lifecycle events on chain. So I think it's important to think beyond, let's say, just the token.
Understood. So we are reaching almost the end of the interview. I would like to ask you one last question. We have been discussing quite a few aspects of the real-world asset space, focusing now in the banking sector, in general. Is there something there that you would like to see? What are some, beyond what we have discussed, some other examples that you would, I don't know, trade finance, for example, that you would highlight that are noteworthy for you?
Yeah, well, I think a lot is happening now with banks and banks beginning to adopt. I think a lot of that's going to revolve around money and payments and FX because that's sort of banks' sweet spot for what they do. One thing I'm seeing is cross-border payments. They seem to be getting a lot of traction, both in the remittance market, although more at the wholesale level rather than consumers touching on either end. But wholesale remittance companies are moving on-chain. And also B2B seems to be getting even more traction. And again, I think this is because it's leveraging a lot of the things that are specific and multiple facets of blockchain, elements of blockchain that are specific to blockchain technology. Cross-border payments leverages peer-to-peer transfers, so you can sidestep the corresponding banking network and multiple interbank transfers and go direct. It allows for instant settlement 24/7, so you don't have to worry about missing cutoff windows at the end of the day. It also results in increased traceability. I was talking to a woman who was operating a business in Latin America, and she has moved all of her treasury into stablecoin. And that's both because, number one, it allows her to dollarize her treasury, but also it allows her to track payments. And so in the market she was dealing with, when she sent a payment out, it would often take 2 or 3 days to reach somebody in another country in Latin America. And we would lose track of it. With stablecoin, it arrives instantly and she can track it through the whole system. So I think that's a tremendous amount of services, a range of services that banks are going to start to offer, and it's very much in the spot of what they do today. FX, we talked about a little bit with the smart collateral use case, but you can see much bigger changes in the market, like maybe a giant AMM, which pulls all of the liquidity in the market and completely changes the way FX is transacted. And then collateral mobility is, I think, the other really, really big one, which is really implied in that, and then the repo case. That's where I'm thinking there's a lot of near-term energy, and the Broadridge announcement recently underlines that. And then finally, I did mention trade finance. There have been a number of attempts that haven't worked out in that market, but I still think that's one of the biggest opportunity areas, and I've got some thoughts about how we tackle that differently than what's happened in the past. That's one of the areas I'm definitely exploring and looking at myself right now.
Great. Last week we talked to Ismael Karam, who is an expert from Argentina, and yeah, it's something very that we see all the time, that businesses and individuals in Latin America are using stable coins to deal with many of the inflationary issues and operational issues and so on that are very prevalent there. So a lot of good use of blockchain technology there. Thank you so much, Mike Manning, for coming on the show. This has been a blast, an illustrious guest for Token City. Thank you so much for coming on the show.
Thank you very much. Appreciate it.
Take care. Bye-bye. Bye. So this was the interview with Mike Manning, strategic advisor and former fintech executive. We hope you enjoyed this. Take care. Bye-bye.